Amazon stock is up 10,000% since 2006 when an investor that you've probably never heard of, Nick Sleep, invested a large chunk of the fund's assets into the company. And the stock had a price to earnings ratio of about 63 at the time. For many value investors, paying any large price to earnings ratio for a company is an absolute sin. Even something like 30 times earnings might be considered very, very high. So 60 times is certainly extremely high. But quiet achiever Nick Sleep invested in these sorts of companies not once, not twice, but a handful of times over the course of 2 decades. And considering the performance of his investment fund, I think he's proven his ability to identify companies that are positioned to grow an enormous amount. And don't think for a second that he's just placing hundreds of little bets and Amazon just happened to be one of those bets. At one point, for over a decade, his investment portfolio consisted of just 3 companies: Amazon, Costco, and Berkshire Hathaway. He made 100x on Amazon, he made 30 to 40x on Costco, and a significant amount on Berkshire Hathaway. So this guy is the real deal. But the story's not over. I mean, obviously, otherwise this video would be 30 seconds long. But not only did he perform extremely well over the course of 2 decades, he actually laid out his entire investment process in his annual letters to shareholders. And while I have talked about some parts of these letters in previous videos, today I want to focus in on what Nick Sleep said about his Amazon investment and why he was so confident to invest a large amount of money into a very early stage Amazon that we now know went on to grow at an enormous rate. Also, I use a number of these key principles we'll talk about today in my own investment process. So if you're interested in getting a checklist of what I look for when I'm analyzing companies, which is made up primarily of Warren Buffett and Charlie Munger value style investing principles, then check out the link down in the description below and you can download it for free. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription. I'm going to be going through 4 key investing principles in today's video, and each of them Nick Sleep spoke about in relation to his Amazon investment that he initiated in 2006. But before we get into that, I do want to talk about one other principle, which was an overarching thing that he spoke about when he closed the fund. When he closed the fund in 2014, he wrote a thank you letter to Buffett. He writes, "It appears to the world that the performance that Nomad has enjoyed over the years was created by Zach and me. This is not the case. As time goes by, the performance that our clients have received is the capitalization of the success of the firms in which we have invested. In other words, the real work is done by you and the good people of Berkshire." Now, in this letter, he's specifically talking about the Berkshire investment, which, as I mentioned, was a large part of the portfolio when he did close the fund. But what he actually says here is a really subtle way of explaining that the majority of the performance and return generated by his fund and through his investment process is on the back of the growth of the companies that he invested in, not necessarily the price that he paid for those businesses. Now, I don't want to act like price doesn't matter. It certainly matters. It is a critical part of the investment process, but it is certainly not what drives the majority of growth when you hold businesses over a 10, 15, or 20-year period. While price, yes, can make a significant difference in getting a business half off versus at full value can make, a massive difference over a long period of time. What is going to drive most of that growth in your return is going to be the underlying performance of the business. Ultimately, investing in companies that have the ability to take their profits and reinvest them back into the business to compound the cash flows of the business. So your emphasis when researching and analyzing companies should be on finding the most high quality businesses. Yes, price plays a role, but high quality is probably the most important factor. Sleep's first principle that he talks about in relation to his Amazon investment is about time horizon. Nick Sleep talks about the importance of having a longer time horizon than the average investor, and he talks about this and the reasoning why in relation to the bond market. So like bonds, equity prices typically have higher returns for longer holding periods. If you were to graph the yields of different bonds on a graph, bonds that have longer to mature will offer higher yields or returns. And this makes perfect sense because the longer that you are locked into a bond, the higher the risk that they won't pay or that inflation will eat away some of your return. Nick Sleep believes that equities or stocks are the same in that investors demand a higher return for a longer waiting period. However, he believes that in some circumstances, a longer waiting period actually reduces the uncertainty of cash flows coming out of that business. In 2006, he wrote, "In our opinion, business outcomes can become more predictable several years out than they are in the near term. For example, we have no idea where the market will end this year, but given corporate strategies, capital allocation, and starting valuations, I think we have some idea of how our companies will evolve over the next few years. In other words, the return from investing in shares can be both increased and de-risked by time." This, of course, goes against the traditional finance understanding, which is that higher risk means higher return, and lower risk means lower return, and that those two are tied at the hip. Value investors like Nick Sleep do not believe this is the case, and that in some cases, having a longer time period, even though most investors will allow for a higher return or demand a higher return for a longer waiting period, there actually may be less risk associated with that. He goes on to explain that even though this is the case, most investors hold stocks for extremely short periods of time. He said, "Other investors hold stocks in our portfolio on average for 20 weeks. We expect to own shares for around 260 weeks. So what is going on? It seems to us that most investors look at the accounting outputs of a company, the reported financial data, as a guide to near-term price movements and play the market accordingly. Zach and I concentrate on a deeper reality, the inputs to future value moves. Our peers are trading shares at the short end of the equity yield curve, where the competition is the greatest, and we are investing at the long end where competition is the least." Nick and his investment partner Zach figured out that most investors are competing aggressively for what stocks will do in the next 4 to 6 months, meaning there's very, very little return to make there, and there's actually quite a lot of risk because stocks are at the mercy of market swings and economics. So what they do instead is they focus a little bit further out where there's less competition and there's actually less uncertainty, because where the business will be 3, 5, 6, 7, 8 years out is much more dependent on the performance of the underlying business rather than the randomness of the economy. So what were these inputs to future value that Nick Sleep focused on and looked for in businesses? Nick said, "We have a little more than a handful of distinct investment models which overlap to some extent." When he says investment models, he's talking really about competitive advantages or economic moats, as Warren Buffett would describe them. Some kind of set of characteristics or the way that a business is set up that provides a significant benefit and barrier preventing competition from stealing the excess profitability that business is producing. Sleep became obsessed with these types of models, and one of them was scale efficiencies shared. Sleep says, "As the firm grows in size, scale savings are given back to the customer in the form of lower prices. The customer then reciprocates by purchasing more goods, which provides greater scale for the retailer who passes on the new savings as well." He went on to say, "Amazon have deployed it so well that Amazon's operating costs per dollar of sales plus its operating margin are less than some of its high street peers' costs per dollar of sales. This offers the prospect that in theory, Amazon's high street peers could price their products at net income break even and still not undercut Amazon's prices or profitability." In simple terms, Amazon had lowered their prices so much, and they were able to do this because of their scale, that if some of their competition wanted to match them on price, those businesses would have to operate at a loss. So they'd have to operate at a loss in order to match them on prices. And what that ultimately means for those businesses is they won't operate at a loss. Maybe they will in short periods, but for the most part, they won't, meaning for the most part, their prices will be higher than Amazon, and they will just slowly bleed customers to Amazon over time. And as that happens, Amazon will, of course, have more sales, their cost per unit will go down, and they will continue to be able to lower their prices, increasing that advantage. And this is one of the most powerful competitive advantages that a business can have, because it can be very, very difficult to impossible for competition to have any chance of competing against them, especially once the business becomes the biggest in the space. Like Amazon right now is massive, their cost per unit is extremely low, and because they decide to take very, very thin margins, it's basically impossible for anybody to beat them on price. Sleep goes on to talk about 2 other key characteristics of Amazon. He said, "A business ought to be able to self-fund its own growth, and if the opportunity set is large, then the return on capital needs to be suitably high. Second, barriers to entry should increase with size. That way, a company's moat is widening as the firm grows. To do this, the basic building blocks of the business, its skeletal structure, is probably best kept very simple. In short, we want a skeletal structure that can support growth from mouse to elephant without too much skeletal re-engineering. So there's a couple of things to unpack here. First of all, businesses for the most part, at least over the long term, should be able to be self-sustainable. So they should be able to produce enough profit in the business in order to invest in the growth of the company. And then also, the company needs to be able to generate significant returns on capital. So it's not enough for the business to produce a lot of profit when they're reinvesting it into the business. If they can generate a 15, 20 or higher return on those investments, and they're investing all of their profit back into the business, then they're going to be compounding and growing the business at 15, 20 or more % per year. And then secondly, a business will become absolutely unstoppable if the barriers grow as the company grows, if it gets harder and harder for competition to compete as that business gets bigger and bigger. And this typically occurs when a business has a simple business model. In Amazon's case, they are simply selling consumer products, and as they scale, their costs go down, and they lower their prices to deliver those cost savings to customers. And that means that it increasingly, at an exponential rate, gets more difficult for competition to match Amazon on pricing. It's important to note that this concept of scale economies shared, where scale efficiencies are delivered to the customer in lower prices, it's not actually just about lower prices, although that seems to be an easy dimension for some businesses to focus on. It also comes in the form of a higher quality experience. So Amazon not only lowers their prices consistently, but they also spend more money to make the experience better. They've spent a lot of money crafting the algorithm and the layout of their website, and they've spent a lot of money on their distribution system to reduce the delivery time and improve the returns process. So those kind of qualitative things about the experience, of course, they could not do those things and then just lower their prices even more, but it's a combination of things that makes their products really, really cheap relative to competition, plus the consumer experience is fantastic. It's the combination of driving additional value to customers in one way or another, rather than just taking it to the bottom line and giving it to shareholders. The combination of those factors is why Amazon has been able to grow and compound at such an exponential rate. Now it's just up to us to find the next company that will do it over the next 2 decades.